Hello, my name is Tyler Chanelli. I'm a professional money manager and options trader. And first off, I want to dedicate this video to Alex Kearns and his family. A very tragic event happened in June 2020. Alex was trading on Robinhood and likely got an option assignment, which caused a temporary negative balance of $730,000. And the purpose of this video and this message is to do whatever I can do to help mitigate this from ever happening again by shining some light on the broker-dealer responsibility as well as the risks of trading options and how this most likely the strategy that was used, just to kind of dive into it a little bit. So first off, you need to really understand the risks of options. I've developed a lot of education over the years. I used to run the Option Trading Coach educational business, which I founded and grew it into over 50 countries. I've since been focusing on building Vestalize, which is a financial technology startup that has an investment management platform to simplify the tracking for securities transactions with a strong emphasis on options. But talking about options, and a lot of retail investors and millennial traders are getting into the stock market due to the volatility from the coronavirus and more time on your hands and so forth. But I need to make sure that you, when you watch this video, that you understand the risks of trading options. And one of the risks that we're going to talk about in this video, there's a lot of them, but the one risk we're going to talk about now is option assignment. So let's say Alex, and the stock is irrelevant. There's a lot of stocks that are in this $1,000 to $2,000 price range. The Amazons, Teslas, Googles, and Shopify's of the world that are up above 1,000 are in that range. Very expensive to buy 100 shares. So the first thing that you should know if you're going to trade options is that there's two types of options. You have a call and you have a put. Now, whether you buy a call or a put, they're all standardized to 100 shares of stock. When you look at this spread example, let's say he did a 1,990. Now, these are the legs of the bull-put spread. The bull-put spread is one of the most prevalent and widely used option spread trading strategies. It's comprised of two legs. So the first leg is the sell, and then the second leg is the buy. Now, I could dive a lot deeper, and I've developed courses and curriculums and education that really dive into this, and it's over several hours. But in this quick demonstration, when you sell a bull-put spread, you're selling a put and buying a further out of the money put, and the goal of the trade is for the stock to stay above the sold strike price on or before the expiration. But ideally, as you get closer to expiration, and what likely would happen with Alex is he had a spread trade on a high price stock, and it could have been like a 5-lot trade, which is like 5 contracts, 5 and 5. So let's just say this is a 5-lot trade, which is 10 contracts, but it's standardized. They balance out. It's packaged. It's a package trade, so it's a 5-lot. But a 5-lot trade, if you were going to buy 500 shares, because again, options are standardized to 100 shares of stock. So a 5-lot example, I mean, that's a $500,000, capital notional value, and that notional value is the risk of what you could see, like with Alex, if you trade options and if you're in a spread trade and you get an early assignment or even a late assignment, but this I think was an early assignment, meaning he was in the bull put spread, whatever the expiration was, you can kind of modify whether they're weekly or a month or a year or more, like the expiration, that's very subjective. But the purpose of this is to say, like, if you are in a put spread and as you get closer to expiration, it becomes more risky, more volatile. The gamma factor changes the delta and the option Greeks. Another very important factor, and this is something where if you go to easyoptiontrading.com, I can tell you all about this through a very detailed course. But this example, and for Alex, what he likely had happen is he had an underwater put spread going into expiration, so a day or two before expiration. If XYZ stock was at maybe say 1050 when he put it on, it's like, things are looking good, chart looks good, I like this spread, this is I think it's going to stay above 1,000 in the next 2 weeks or whatever that expiration time frame was. Now, if you fast forward and you're a couple days before expiration and the stock's at, say, down here at 950, that's a little bit of a problem. But what you need to understand is that it's a defined risk trade. There's a $10 spread differential between the long and the short. That $10 spread differential, again, options are standardized, so keep the same 100, everything you multiply by 100. So 10 times 100 times 5 is a $5,000 max risk. That's the most you can lose as a retail investor, as a trader. If something else happens outside of this defined risk spread trade, now there's some spread widths that can make it maybe a little more, but give or take, that's your defined risk characteristic. This 5-lot trade is risking the most you can ever lose, give or take a couple pennies if you have to pay a little more than $10 to get out of the spread, is $5,000. This is defined. This is very important if you're new, if you're trading options. Keep your spread trades defined. When you go 5 and 4 or 5 and 3, that becomes undefined, that's unbalanced, that's a totally separate discussion. It's important, it's a little more advanced, and that's something I can help you with, but the topic at hand is early assignment and what happens. Okay, so you get an early assignment, you sell these 5, which is a minus, and then you buy these 5. So if you sell, so the definition of an option is it gives you the right but not the obligation to buy 100 shares of stock on or before the expiration date. So if you're a buyer, that's very black and white. But if you're a seller, it's the opposite. You're obligated to deliver shares to the counterparty, and that's what happened here. He was obligated, which the broker facilitates, and it's all electronic now. But this 5-lot, this 500 shares equivalent, and it was a little more for him because it was about 700,000, but you're getting the whole lesson here. This example, the 500 shares risk, it was a margin call. So the $730,000, it's likely a margin call, and some of the technology on some of the new fintech apps, and I don't want to single out Robinhood because they're doing a lot of things really well, and they're a great up-and-coming company, and I hate to see them get a bad rap for this, but this is something that needs to get improved. I'm trying to shine light on. I've had investors that are getting involved with Vestalize and asking questions that have brought this up to me recently, and it's something that I felt compelled to shoot a video on to explain this. If you're ever in a situation, reach out to us at Vestalize. We can help you with this. It's a very simple, a 5 or 10 minute conversation could have alleviated the whole issue. That's a side note. But to close out this demonstration, if you get an early assignment, a lot of times your broker closes it out for you. And if you're in a defined risk spread, you can't lose more than your spread width times 100 times the quantity. So that's a $5,000 risk. I think he had a little more than that in his account, and the $730,000 was basically a margin call. It was the capital required to hold the assigned shares that were long or short. I don't know the mechanics of the trade, but I know the understanding behind option assignments. It happens to me all the time, and it's something that will likely happen to you if you trade options. So what you need to do is you need to be educated. So go to easyoptiontrading.com, sign up for the free video series, learn about how this can help you. If you're brand new, great. If you're experienced, I can also help you. And then after you do that, we'll get you synced up into the Vestalize platform to where you can start to track your trades, have the transparency, the analytics, reporting, and the ultimate automated tracking tool to help you reach your goals as a self-directed retail investor. That's all for now. Take care, be smart, stay regimented, stay disciplined with your trades, don't over leverage, understand the concepts, the principles, the strategies before you ever put live dollars at work. I hope this served you, and we'll be in touch.